When a company repurchases its own shares, which are known as treasury shares, it can either keep those treasury shares and at a later point in time, maybe it will sell the treasury shares, or maybe it will give them to some of its executives, maybe to the CEO. But it could also, instead of deciding to keep the treasury shares, it could decide to retire the treasury shares. When a company retires the treasury shares, it's effectively canceling the shares. It's as if they are no longer issued. Okay, so let's go through the accounting of how this would work. So let's say we've got a company called Caffeinated Broccoli, and the company's board of directors authorizes the issuance of 100,000 shares of common stock. Okay, so we're going to go right from the beginning. They've issued 100,000 common shares. There's a par value of $1 a share. They issue the shares for $600,000. So the company is going to debit its cash account. It's going to increase the cash account by $600,000. It's going to credit common stock for $100,000, which is $1 par value per share times 100,000 shares that are being issued, and then the remaining credit is going to be additional paid-in capital for $500,000. So this is the journal entry to record this in the financial system, and at the end of this, the company has 100,000 shares authorized by the board of directors, and 100,000 shares have been issued, and there are 100,000 shares outstanding. Outstanding means they're out there floating around in investors' hands, okay? So now the company is going to repurchase 20,000 of those shares for $9 a share. So what they're going to do is they're going to debit the treasury stock account. Remember, that's a contra equity account. It is not an asset. So $9 a share times 20,000 shares is $180,000. So you're going to debit treasury stock for $180,000 and reduce the cash account by $180,000. And now, okay, after they've repurchased the shares, there's 100,000 have been authorized, 100,000 have been issued, but now there's only 80,000 shares outstanding out there floating around in investors' hands, okay? So take note of that, because when they retire the shares, we're going to have another wrinkle, okay? So they retire the 20,000 shares, let's say, that they had repurchased. Okay, so we had these treasury shares, 20,000, and they say, you know what, we're just going to retire them. We're not going to keep them. We're not going to, sell them or anything. We're just going to retire them. So what do? Well, we had, when they originally repurchased the shares, they had debited the treasury stock account for 180,000. So we need to credit the treasury stock account for 180,000. Now, in terms of the debits, okay, this side, what we're going to do is we're going to go back to the original entry. Remember when so basically there was $1 par value per share. So $1 par value per share times 20,000 shares. We are going to reduce the common stock account by $20,000. Again, this is $1 par value per share, and we're reducing, we're canceling 20,000 shares. So we're going to reduce the common stock by $20,000. Now, the additional paid-in capital is also going to be reduced. If you remember, the additional paid-in capital in total for 100,000 shares was $500,000. Okay, that's the journal entry we had back here, 100,000 shares, and we had 500,000. So that's $5 of additional paid-in capital per share. So we have 20,000 shares we're retiring. 20,000 times 5 is 100,000. So this is why we're debiting additional paid-in capital for $100,000. Now, notice, if we just debited common stock and debited additional paid-in capital, we're basically reversing like part of the original issuance of the shares, and we're saying, okay, you know what, that par value and the additional paid-in capital, we reduce those, but 120,000 of debits does not equal 180,000 of credits. So we need an extra debit for 60,000 to make our debits and credits balance, and the debit goes to retained earnings. Okay, now note the following. The number of shares authorized by the board has not changed. That's still 100,000. The number that are issued and outstanding, though, is now 80,000. Okay, so before, when we just repurchased the shares, it reduced the number of shares outstanding. But now, when we retire them, it reduces the number of shares issued. Okay, so that's the difference here between just repurchasing the shares and retiring them. When we repurchase them, it reduces the number of shares outstanding. When we retire them, then that also reduces the number of shares issued. Now, note, in the United States, some states actually have laws about how to account for treasury shares and how you would account for the retirement of shares. So if you're in the U.S. and your specific state has laws about how to account for the retirement of shares, those laws would take precedence. If they're different from everything I've outlined in the video here, those laws will be the appropriate accounting treatment for how you would deal with the retirement of shares.